The headlines scream betrayal. The world's largest asset manager, a titan controlling over $10 trillion, has supposedly abandoned America. $2.1 trillion, they say, fleeing to foreign shores in the dead of night. A capital exodus. A vote of no confidence, the beginning of the end. But here's what the headlines won't tell you. That number is a distortion wrapped around a truth far more unsettling than a simple exit story. Because BlackRock didn't pack up and leave. They did something far more calculated, far more revealing about where we actually stand in the long arc of economic history. What BlackRock did was send a signal. And if you know how to read it, that signal tells a story that's been repeating itself for 500 years. A pattern so consistent, so ruthlessly predictable, that once you see it, you can't unsee it. It's the story of how empires rise, how they peak, and how they enter the long, quiet slide into something else entirely. Let me take you back to a different time to show you what I mean. The year is 1780. Amsterdam is still wealthy beyond measure, really. But something has changed. The money is restless. The great merchant families, the ones who built the Dutch Republic into the world's financial center, are quietly shifting their gold and silver out of Dutch guilders and into British pounds. Not all at once, not dramatically, but deliberately, persistently. Week after week, month after month. The Bank of Amsterdam, which had been the rock of global finance for over a century and a half, begins to tremble. Their vaults, once overflowing with coin, start to empty. Receipts that used to be rolled over continuously year after year suddenly aren't being renewed. People want their metal back. They want to hold it in their hands, to move it somewhere safer, somewhere more stable. Within 3 years, the guilder collapses. The British pound becomes the world's new reserve currency. And Amsterdam, despite still being one of the richest cities on earth, never again commands the same financial gravity. This wasn't the first time it happened. A century earlier, Spanish silver had dominated global trade. The Spanish real, backed by the endless mines of the New World, was the currency everyone wanted, until it wasn't. Until Spain's debts overwhelmed its ability to pay. Until inflation gutted the value of all that's silver. Until merchants and kings alike began looking elsewhere for stability. And it won't be the last time it happens either. Because here's what every dominant currency in history has in common. They all reached a point where the people holding them, the central banks, the pension funds, the sovereign wealth managers, began to quietly, carefully reduce their exposure. Not because they hated the currency, not because they wanted it to fail, but because the mathematics stopped making sense. Because the burden of debt grew too heavy. Because the interest payments became too expensive. Because holding long-term obligations in that currency started to look less like prudent investing and more like a slow-motion trap. That's where we are now. And that's what BlackRock's move really signals. Let's cut through the noise and get to the facts, because the truth is more nuanced than the $2.1 trillion exit story suggests, but it's also more important. In December 2025, BlackRock released their 2026 Global Investment Outlook. Buried in the technical language and charts was a single phrase that sent ripples through financial markets: tactically underweight long-term U.S. Treasuries. For most people, that phrase means nothing. For those who understand markets, it's a thunderclap. BlackRock wasn't selling everything. They weren't pulling out of America. They remain heavily invested in U.S. equities, particularly in artificial intelligence and technology companies. They're still bullish on American innovation, American productivity, American corporate profits, but they've made a calculated decision to reduce their exposure to one specific thing: long-term U.S. government debt. The distinction matters. U.S. Treasuries have been considered the safest investment on the planet for nearly a century. They're the asset central banks hold when they want absolute security. They're what pension funds buy when they need reliable, guaranteed returns. They're the bedrock of the global financial system. And BlackRock, the single largest asset manager in human history, has just said they're underweight on them. Now, underweight doesn't mean zero. It means they're holding less than the benchmark would suggest. It means they've tilted their portfolio away from long-term bonds and toward other assets. But when an institution managing over $10 trillion in assets makes that tilt, the implications cascade outward like shockwaves through water. The $2.1 trillion figure that's been floating around in headlines appears to stem from a misunderstanding, or perhaps a deliberate exaggeration. That number roughly represents the total amount of capital BlackRock has been reallocating across all asset classes as they adjust their global strategy. Some of it's moving to European markets, some to emerging economies like Brazil and India, some into private credit, some into commodities and gold. But it's not a wholesale abandonment of America. It's a diversification away from a specific kind of American asset: long-dated government debt. Why? Because of a problem that's been building for years, accelerating for months, and is now impossible to ignore. As of early February 2026, the United States national debt stands at $38.4 trillion. Now let that number settle for a moment. $38.4 trillion. That's roughly 100% of America's entire gross domestic product. It's $113,000 for every single person in the country. It's $285,000 for every household. But the absolute size of the debt isn't what's causing institutions like BlackRock to recalibrate. Debt in itself isn't necessarily destructive. Japan carries a much higher debt-to-GDP ratio and has managed it for decades. What matters is the trajectory of the debt, the cost of servicing it, and the market's confidence in the borrower's ability to pay. On all three counts, warning lights are flashing. The debt is growing at a staggering pace. Over the past year alone, it increased by $2.25 trillion. That's $6 billion added every single day. Every hour, $255 million. Every minute, $4.25 million. Every second, $70,000. The debt doesn't sleep. It doesn't take weekends off. It compounds relentlessly every moment of every day. But here's where it gets truly alarming: the interest payments. In fiscal year 2019, the United States paid $375 billion in interest on its debt. Expensive, yes, but manageable. It represented about 1.7% of GDP. By fiscal year 2025, which ended in September, that number had more than doubled to $952 billion. It now represents 3.2% of GDP. And in fiscal year 2026, we're only a few months in, but the trajectory is clear. Interest payments will exceed $1 trillion. That's more than the United States spends on Medicare, more than it spends on national defense, more than all non-defense discretionary spending combined. Education, law enforcement, infrastructure, scientific research, everything. Think about what that means. More than $1.06 of all federal spending now goes purely to servicing old debt. Not building anything, not feeding anyone, not defending the country or funding innovation, just paying interest on money that was already spent years ago. And here's the kicker. Interest rates are still relatively modest by historical standards. The average rate on U.S. debt right now is 3.38%. Back in the early 1980s, rates hit double digits. If rates were to rise back toward those levels, and there's no fundamental reason they couldn't, the interest payments wouldn't just be expensive, they'd be catastrophic. They'd consume so much of the budget that everything else would have to be cut dramatically, or taxes would have to rise to politically impossible levels, or the debt would spiral completely out of control. This is what former Treasury Secretary Janet Yellen warned about in early January 2026. She called it fiscal dominance, the point where the debt becomes so large that the Federal Reserve loses its ability to fight inflation through interest rate policy, because raising rates would bankrupt the government through exploding interest costs. It's the economic equivalent of being trapped in your own car, unable to use the brakes because they'd cause the entire vehicle to disintegrate. BlackRock looked at these numbers. They looked at the trajectory. They looked at the political gridlock that makes meaningful deficit reduction virtually impossible. And they made a decision. Long-term U.S. Treasuries, which are most sensitive to rising interest rates and fiscal concerns, are no longer an attractive place to park capital. But BlackRock isn't alone. They're not some rogue actor making an idiosyncratic bet. They're the tip of a much larger iceberg, the visible manifestation of a shift that's been happening quietly beneath the surface of financial markets for years. Foreign central banks, the institutions that have traditionally been the biggest buyers of U.S. Treasury securities, are reducing their exposure. China, once the largest foreign holder of U.S. debt, has cut its holdings by nearly half. At their peak in the early 2010s, China held more than $1.3 trillion in U.S. Treasuries. Today, $680 billion. A systematic, years-long drawdown that shows no signs of reversing. Japan, now the largest foreign holder, has seen modest increases recently, but that's more a function of limited alternatives than enthusiasm. Japanese institutions face domestic constraints, low yields at home, limited investment options that provide both scale and liquidity. U.S. Treasuries still meet those requirements, but the demand is driven by necessity, not conviction. The United Kingdom, Belgium, France, traditional U.S. allies, have actually increased their Treasury holdings over the past year. But look closer, and a different picture emerges. The UK's holdings are largely custodial, hedge funds and institutional flows routing through London, not necessarily British governmental confidence, and the increases are modest, nowhere near enough to offset the declines from other major holders. Meanwhile, BRICS nations, Brazil, Russia, India, China, South Africa, saw significant sell-offs in 2025. Brazil's holdings fell 27%. India cut theirs by 20%. These aren't random fluctuations. They're strategic decisions by governments that have been openly discussing alternatives to dollar dominance for years and are now acting on those discussions. And what are they buying instead? Gold. Central bank gold holdings have been surging. After gold prices more than doubled from the start of 2025 through early 2026, central banks worldwide find their gold reserves worth more than at any point in decades. But they're not just watching their existing gold appreciate, they're actively buying more. In late 2025, gold's share of global central bank reserves surpassed U.S. Treasuries for the first time since 1996. This is the silent exodus. Not a panic, not a crisis, not a collapse. Just a steady, deliberate, strategic reduction in exposure to dollar-denominated long-term debt, happening month after month across dozens of countries, orchestrated not by conspiracy, but by cold calculation of risk and return. BlackRock identified a second major concern in their outlook, one that compounds the debt problem. The financial system is becoming more leveraged at precisely the wrong time. The artificial intelligence boom, and make no mistake, it is a genuine technological revolution, requires staggering amounts of upfront capital. Companies are building data centers the size of small cities. They're securing long-term energy contracts. They're ordering advanced semiconductors years in advance. Microsoft, Google, Amazon, Meta. These companies are collectively spending hundreds of billions of dollars on AI infrastructure. The problem? The revenue from AI is largely theoretical and far in the future. The costs are real and immediate. That creates what BlackRock calls a financing hump, a period where companies need massive amounts of capital to bridge the gap between investment and return. Where does that capital come from? Debt. Corporate leverage is rising rapidly, and simultaneously, government debt is soaring to pay for everything from defense to entitlements to interest on past borrowing. The entire financial system, public and private, is taking on more debt at the same time. This wouldn't be catastrophic if interest rates were low, but they're not. And if rates rise further, which they likely will if inflation proves stickier than hoped, or if fiscal concerns drive up the term premium investors demand, the system becomes dangerously fragile. A highly leveraged financial system is vulnerable to shocks. A spike in bond yields, a geopolitical crisis, a recession that dries up tax revenue. Any of these could trigger a cascade of margin calls, defaults, and forced deleveraging that makes 2028 look like a dress rehearsal. BlackRock, reading these tea leaves, has decided that traditional diversification strategies, like loading up on long-term government bonds as a hedge against risk assets, no longer work. Bonds aren't providing the portfolio ballast they once did. When debt is high enough, bonds and stocks can both fall together, leaving investors with nowhere to hide. So what's the alternative? Active management, private credit, emerging market debt, commodities, infrastructure, real assets that can hold value independent of any single currency. A more complicated, more expensive, more hands-on approach to portfolio construction, but one that acknowledges the reality that we've entered a new regime where the old rules no longer apply. This has happened before, not just once, multiple times, and each time the pattern is eerily similar. When the Dutch guilder lost its status as the world's reserve currency in the late 1700s, it didn't happen because of a war or a revolution or a sudden catastrophe. It happened because the Bank of Amsterdam, under pressure to fund wars and maintain colonial holdings, began lending more than its reserves could support. The bank created paper claims on gold and silver that exceeded the actual metal in its vaults. When people realized this, when confidence began to crack, there was a run. The bank collapsed. The guilder collapsed with it. And the British pound, already rising in prestige due to Britain's naval dominance and growing empire, stepped into the void. The British pound reigned for over a century, but by the 1920s and 30s, the pattern began again. Britain's debt from World War I was crushing. The costs of maintaining a global empire were unsustainable. The pound was overvalued, causing economic stagnation at home. Britain tried to return to the gold standard at pre-war parity, a decision that strangled their economy and ultimately failed. Other countries began moving reserves out of sterling and into dollars. By the end of World War II, the transition was complete. The dollar, backed by the world's largest economy and a massive gold reserve, became the new global standard under the Bretton Woods Agreement. Now, we're watching the third act of this play. The United States, like Spain before it and the Netherlands and Britain after, has accumulated debts it struggles to service. It has global commitments, military bases in over 80 countries, security guarantees to dozens of allies, entitlement programs for a rapidly aging population that dwarf its revenue base. It has lost manufacturing competitiveness in key sectors to rising powers, particularly China. And, crucially, it has begun to exhibit the classic signs of late-stage imperial overstretch: political gridlock, social division, and an inability to make the hard choices necessary to secure long-term stability. The dollar is still dominant, still indispensable, still the currency everyone needs for global trade. But dominance isn't permanent. It's contingent on trust, on stability, on the belief that holding long-term obligations denominated in that currency is safe. And that trust, slowly but surely, is beginning to fray. BlackRock's move isn't causing this fraying. They're responding to it. They're reading the same history books, looking at the same patterns. And making the same calculation that smart money is made at every inflection point in monetary history, it is time to diversify away from concentration in a single reserve currency. Here's a framework that might help make sense of what's happening. Think of reserve currency dominance as happening in stages. Stage 1 is ascendancy. The currency is backed by economic might, military power, innovation, and fiscal discipline. Everyone wants it. Everyone trusts it. It becomes the standard by which other currencies are measured. Stage 2 is peak dominance. The currency doesn't just facilitate trade, it defines it. Global commodities are priced in it. Central banks hoard it. Governments denominate their debts in it. The issuing country enjoys what economists call exorbitant privilege, the ability to borrow cheaply, to run larger deficits than other nations could sustain, because demand for the currency is structural rather than elective. Stage 3 is the silent exodus. The currency is still widely used, still necessary, but the smart money begins to diversify. Not dramatically, not publicly, but persistently. Foreign holders reduce their exposure at the margins. Alternative reserve currencies gain small but meaningful market share. Gold becomes fashionable again. The issuing country's fiscal position deteriorates, but because the currency is still dominant, the consequences are delayed. Interest rates stay low even as debts pile up because demand remains strong. This can last for years, even decades. Stage 4 is the crisis. Something breaks. A war, a default, a political upheaval, a loss of military capacity. Whatever the trigger, confidence evaporates suddenly. The currency plunges, interest rates spike. The issuing country, unable to borrow cheaply anymore, faces austerity, hyperinflation, or both. A new reserve currency emerges, and the cycle begins again. The United States is deep into stage 3. We're not in stage 4, not even close. The dollar is still the world's dominant reserve currency by a massive margin. Roughly 58% of global central bank reserves are held in dollars, a percentage that has declined gradually but remains overwhelming compared to any alternative. But stage 3 can last a long time. The British pound remained a reserve currency for decades after it was clear that the US dollar was ascendant. Even today, sterling still accounts for about 5% of global reserves. The transition isn't a light switch, it's a dimmer, slowly turned down over years and decades. What BlackRock is signaling is that they believe the dimming has begun, that the trajectory is clear, that the time to reduce concentrated exposure is now before the transition accelerates. If you're watching this, you're probably wondering what any of this means for your life, your savings, your future. And the answer depends on where you stand and what you hold. If you own long-term U.S. Treasury bonds directly, or if you're in bond funds heavily weighted toward long-dated government debt, understand that you're holding an asset that major institutions are actively reducing their exposure to. That doesn't mean you should panic and sell. It means you should understand the risk. If interest rates rise, or if fiscal concerns drive up the term premium, the value of those bonds will fall, potentially significantly. If you're heavily concentrated in any single currency, including dollars, consider whether that concentration still makes sense. Diversification across currencies, especially through assets that naturally hedge against dollar weakness, foreign stocks, commodities, precious metals, might provide stability that pure dollar holdings won't. If you're young, this matters less in the short term. Equities, especially in innovative sectors like artificial intelligence, have room to run regardless of what happens to government bonds. But it matters enormously for long-term planning. The assumption that U.S. assets are always the safe haven, that dollar dominance is eternal, that 30-year Treasury bonds are risk-free, those assumptions are increasingly questionable. If you're approaching retirement or already retired, this matters immediately. Because fixed income, bonds, CDs, government securities has traditionally been the foundation of conservative portfolios. The idea was simple: trade growth for safety. Accept lower returns in exchange for stability and preservation of capital. But if long-term government bonds are no longer providing that stability, if they're vulnerable to both inflation and fiscal risk, then the traditional playbook needs revision. More diversification, more attention to credit quality, more exposure to real assets that can hold value even if currencies fluctuate. And if you're thinking about the world your children or grandchildren will inherit, this is perhaps the most important question of all. Because reserve currency transitions aren't smooth, they're disruptive, they redistribute wealth and power on a global scale. Workers in the ascending country benefit from rising demand for their goods and services. Workers in the declining country face stagnant wages and eroding purchasing power. The political tensions this creates can be severe. We're already seeing hints of it. Rising populism, anger at elites, suspicion of international institutions, a retreat from globalization. These aren't random phenomena. They're symptoms of a deeper shift, the kind that happens when economic plates grind against each other deep beneath the surface of daily life. None of this is inevitable. History offers patterns, not prophecies. The United States could still course correct. It could address its fiscal problems through some combination of spending restraint, revenue increases, and economic growth. It could restore trust in its long-term fiscal trajectory. It could delay stage 4 for generations, but doing so would require political will that seems absent. It would require leaders willing to tell uncomfortable truths. That entitlement programs need reform, that defense spending needs scrutiny, that tax increases might be necessary, that there's no painless path forward, and it would require citizens willing to accept shared sacrifice for long-term stability rather than demanding immediate gratification and low taxes simultaneously. So far, that political will hasn't materialized, and every year it doesn't, the problem compounds. Every $1 trillion added to the debt makes the eventual reckoning more severe. Every year of kicking the can down the road narrows the range of available options. What BlackRock has done, in their quiet, technical way, is acknowledge this reality. They've stopped pretending that everything will magically work out. They've looked at the mathematics, the political dysfunction, the historical precedents, and they've adjusted accordingly. They're not betting against America. They're betting against complacency, against the assumption that past dominance guarantees future dominance, against the idea that you can run trillion-dollar deficits indefinitely without consequences. And whether or not you hold $10 trillion in assets like BlackRock does, the same logic applies to your own financial decisions. Assumptions that worked for decades might not work going forward. Diversification that seemed unnecessary when the dollar was unquestionably supreme might be essential now. Strategies that prioritized convenience over resilience might need reconsideration. There's something both fascinating and terrifying about watching this unfold in real time. Because unlike a stock market crash or a banking crisis, sudden dramatic events that demand immediate response, this is gradual, month by month, quarter by quarter, decision by decision. Capital flows shifting slightly, portfolio allocations adjusting marginally, central banks diversifying incrementally. Most people won't notice until it's already happened, until the history books are written, until economists look back and mark this decade as the pivot point, the moment when the silent exodus became undeniable. But the patterns are there for anyone willing to look. The warning signs are clear. The mathematics don't lie. BlackRock moved $2.1 trillion, or more accurately, they adjusted their allocation strategy in ways that suggest a $2.1 trillion reorientation of global capital. It wasn't dramatic. It wasn't panicked. It was methodical, calculated, and based on a clear-eyed assessment of risk. The question now is whether the rest of us are paying attention, whether we're learning from history or doomed to repeat it, whether we'll recognize the signal for what it is, or whether we'll dismiss it as noise until it's too late to adjust. The great currency transitions of history, Spanish silver to Dutch guilder, guilder to British pound, pound to American dollar, all seemed inevitable in retrospect. But they weren't obvious in real time. People living through them were confused, uncertain, dismissive of warnings that proved prescient. We have the benefit of historical perspective. We can see the pattern, we can read the signals. BlackRock just sent one loud and clear. Are you listening? If you found this breakdown valuable, make sure to like this video and subscribe to the channel. We're going deep on the economic forces reshaping the world, cutting through the noise to show you what actually matters. Because understanding these patterns isn't just academic, it's essential for navigating what comes next. Thanks for watching, and I'll see you in the next one.